advising clients across the country. Here he is, your host, J. Christopher Boyd.
Welcome back to Something More with Chris Boyd. I'm Chris Boyd, certified financial planner practitioner, and I'm here with Jeff Perry. And our next guest joining us is our Chief Investment Officer, Brian Regan of Asset Management Resources. And thanks for being here, Brian.
Hey guys, how are you?
Unbelievable. That's always the best way to answer that. It covers it either way. But unbelievably good today. So in any case,
Like
before
when you meet somebody, you're not sure where you know them from, and you're like, just say nice to see you. So
Always. I learned that in politics.
that's a good political lesson.
how you doing? Right. Anyway,
Joe,
so
that's a Joey Friends reference.
that's
Yeah.
that's right.
In case anybody had forgotten.
So in any case, before we jump into some of our planned topics, I want to take a moment to thank Armin Avakian, who has been our show's producer for a while. How long has it been? About 2 years almost. Yeah. So, and Armin is leaving AMR onto greener pastures and new adventures. So, wishing
We'll see if they're greener.
Yeah, exactly. I
Done a
get
great
sense
job.
maybe they're greener.
Greener. Oh, okay.
Well,
That happened.
But in any case,
He's done a great job for all the things that I've worked him for. Thank you, Armin, for making us look better than we are.
that's right. That's all right. Taking some of those edits and clips, and we need our little bologna sauce stuff coming in here right about now. But in any case,
The job description, make us look better than we are.
Yeah.
But Armin, thanks for all you've done for us over the last couple of years, and thanks for being with us. And you'll be missed. So let's tune to. He's saying thank you, by the way. Just we don't have his microphone on, but anyway, thanks, Armin.
He's halfway out the door. What are you talking about?
Yeah. Right. Well, last day.
Yeah.
So in any case, let's talk about some other things, though. We do have some things we wanted to talk about that are relevant. Brian, as far as markets are concerned, it doesn't seem like markets have been too worried about what we keep hearing, and we've been talking a little bit about with the debt ceiling issues. Markets this year seem to be doing fine.
Better than fine. Market's doing great. And I think this, we talked about this in the quarterly, so I just think it's really good to revisit those things. It's can sometimes be easy to forget about what you talked about and what your main thesis was just, a short period of time ago, because
That's true.
the news comes at you hard and fast. So it's good practice, I think, to go back and revisit, what you were thinking when you made the asset allocation decisions. And, I go back and I sometimes I think, what were we thinking a year ago? Was it right? Was it wrong? Why were we wrong? Why were we right? Is it applicable to what's going on today? If yes, then why? If no, then why? And I think that's really the practice. But the market's been doing very, very well lately, and the overwhelming sentiment that I feel, maybe not personally, but I feel that other people have and share, is that this isn't right. It wasn't in the playbook that they imagined at the beginning of the year. And I think a lot of that was recency bias because 2022 was so bad. But it's important to note that, some of these stocks are just going wild. If you look at, the S&P 500 is up about 9% year to date, but mega cap growth stocks are up almost 25% year to date. And it is, has been leading the market and has been part of the reason why the market has gone up. And a lot of people will say that there's not a lot of breadth in the market, and it's only a few stocks, bringing the market higher. There's some truth to that, but I think a lot of it might be sour grapes from people who maybe were attracted to those 4 or 5% yields and have been sitting in cash and maybe missed the boat. Because if you look at the S&P value index, that's still up almost 6%. Even if you look at the S&P 500 equal weighted index, it's still positive. So, I think a lot of that talk might be sour grapes. I'm interested you guys might have a better grasp and feel about how clients are feeling individually. I think my perspective is more from professional investors. I'd be interested to hear, the sentiment that you're feeling and hearing from the clients.
I have some comments, but Jeff, do you want to comment first, or do you want me
Sure.
to?
It's very, very individualized from my perspective, Brian. I think clients who have a stronger political bias, either side, that bias and their absorption of information from their respective spheres is guiding them still. Meaning, if they are Republican leaning, which most of my clients happen to be, they have almost a preset negative view of what's happening in the economy. If they're more agnostic or not involved in politics, they may have a more balanced look at the world, and they're more on the numbers. I have one client who I had a meeting with this past week, and he just has a number in his head. And he told me what that number was months ago. He said, I'll be happy when my account is worth this. And his account is worth 5% more than that number. So I had a meeting with him yesterday, and he's like, everything's good. We're above this level. So, I mean,
At least he held true to that.
he was.
Yeah,
And
right,
I actually
right.
wrote down the number. So could remember it because it's important to him. He tried to make notes about what's important to the clients and how they look at things.
Yeah.
And that's his view. And so, that view is very rational to me. Like, this is what I would expect for my return to be at this given time. And he was talking about, actually, he has some CDs. So this is it's anecdotal. It's one person. But he was talking, he has some CDs rolling off in September and October. And he's starting to feel like, I think the market is stabilized. We're out of that bad year last year. Maybe it's time to, depending on interest rates, assuming they're going to be stable or go down, put some of that capital back in risk, back into the market, so to speak. So for me, it's very individualized, depending on where the person is, what's their own views of the world, I guess.
I would add to that I think a lot of clients are focused on last year still, and they're still feeling the consequence. They haven't reached that high water mark. We hit a higher point. We've fallen from it, although markets have begun to rebound and have seen meaningful recovery. We're not where we were. We're not at our highs, and so I think that's a bit of the focus where they feel anxiety around their investments. And of course, you add to that then all the stuff Jeff was talking about, the fact that there's anxieties in the world, whatever, you pick your poison, whatever that happens to be, and there's reason to say, oh, we're looking at a recession, oh, the debt ceiling, oh, fill in the blank, whatever it is, right? And that there's cause for further anxiety and things, the worry that things aren't going to turn around or ultimately recover to their liking. You talked about the breadth of the market, Brian, and the lack of breadth of the market, the sort of narrowness of the number of names that have had this sort of significant impact or outsized impact on the performance of the market. I'd be curious to get your take on, relative to some of their highs, how are some of these mega cap names holding up? Have they come closer to rebound to their prior highs, or are we still, making progress but still have a ways to go?
That's an interesting question. So I actually felt the need to trim some Apple stock in our client portfolios this week because I just thought it got ahead of itself. So we talked about just the amazing run at some of the bigger stocks. The Apple's about 8% of the S&P 500, 7-8% of the S&P 500. That's a pretty massive amount. And we are shy of that in our individual stock discretionary portfolio allocation, but we also own Berkshire Hathaway, which has a big Apple stake. We also own Broadcom, which is a big Apple vendor. So I think those things are, worthy of taking into consideration. But, when you have the biggest stock in the index, if you look at the NASDAQ, mega cap, large cap growth stocks, just explode year to date, it's worth taking a look to see if the valuations have gotten ahead of itself. Just because the valuation gets ahead of itself too, it doesn't necessarily mean you should sell the whole thing. I said I trimmed it. We still have a healthy allocation. It just got ahead of it. If we wanted a 4% allocation and it jumps to 6%, it's very reasonable to take some of that down, and that's about the calculus that we made.
Some of the good practices that to impose, this idea of sometimes a little rebalancing, sell high and buy low, ultimately has some cumulative benefit.
Yeah, I mean, I actually don't like doing it.
It's tough to do it when you have a winner.
I'd rather buy a stock and have it, run forever. But the fundamentals of the business need to grow with the price, and if that's not happening, then it's, in my opinion, it's better to trim, and maybe you'll get another, buying opportunity in the future if the price corrects. It's also possible that the fundamentals could catch up to the price later on, right? People say that the market's forward looking, and it is. And if that's the case, in this stock in particular, then the metrics for Apple should get much better, in the near future. And I'd welcome that too, because we still own it. Microsoft, another big stock in those indexes, the second biggest stock. Apple's number one, Microsoft's number two. It's gotten huge tailwinds from really ChatGPT and the AI talk. But quite frankly, I thought it was wildly underpriced for a little while there throughout 2022. In just December, it was trading in the 240s. Now it's well over 300. It was under 20 times EBITDA, maybe under 20 times earnings in just December, just 6 months ago. And this is a company that's consistently growing revenue by 16% per year over the last three or 5 years. Really nice operating margins. Moved to a subscription business. Has a moat as wide as any company short of a true monopoly. And we talk about constantly the things that should drive the valuation of a stock. I think the two biggest things are growth and consistency, and Microsoft has them both. So we've seen a big rebound in that stock along with Apple, but that one's still, since it was so underpriced, it's still reasonably priced today, I think.
We have just a couple minutes before we want to take a break, so I don't want to get in too lengthy a discussion. But we've seen this year, and you were talking about the perspective of from the beginning of the year to recent quarter to conversation to remind sort of that we had this expectation that things might improve, and things have. And one of the things that has happened a lot in this time is this focus on the bank problems. And how is that? Is that something that is more sector specific? Is it something that we think can have some longer term implications for the health of the economy and therefore stock profitability? How does the banking issues play into? Give us some perspective around that.
Well, I think the Fed hit the tripwire, and instead of moving 100 basis points over the next 2 meetings or 200 basis points, the regional banks are going to do it for them. Money's going to get tighter, and it's going to solve this inflation problem quicker. And in my opinion, that should stabilize longer-term interest rates, which should be a buoy to stocks, which it has been this year. It's quite possible that that tripwire could be a really bad tripwire, though, and that's something worth monitoring. So far, that has not been the case. There's certainly been a contraction of credit that's likely to continue, but we're still seeing good sales numbers. We're still seeing good job numbers. The unemployment numbers that came out on Thursday were shockingly encouraging. Continuing claims actually went down, which was unexpected. So the economy, despite all that, still in good shape. It might not be shape 6 months ago. I'm not saying that, but I'm saying state of things today are pretty good. And the bank, what the bank's have done is just, maybe taking 100 basis points of Fed rate hikes off the table. It's bad for that sector. It might be good for the overall economy.
Well, we've
Or at
got
least good for the
plenty of things more to talk about. Brian's going to stay with us. We're going to talk a little bit about some case lessons as well, some things we've noticed over the last couple of weeks and months, things that we can share with you as our listeners. We do have to take a break for the news. And I want to remind you that if you have the chance and you're interested in learning more about Social Security and Medicare, join us for the upcoming event that we have planned. This is an educational talk on June 6th at 9 to 11 in Hyannis. Reach out to us through our website, amrfinancial.com, to register and learn more. You can always reach out to us for help as well if you have any needs through our website, amrfinancial.com. Or 508-771-8900. If you don't catch all of our show each week on the radio, make sure you're listening to our podcasts wherever you like to listen to your podcasts. We'll be right back right after this.
I didn't realize that was the 16-minute one.
That's our hour one,
Oh, one.
16
Yeah.
minutes.
Okay, ready?
Welcome back to Something More with Chris Boyd. I'm Chris Boyd, certified financial planner practitioner, and my office is Asset Management Resources. We're a registered investment advisor firm. And as you know, our show is a financial show. We talk about not only those important dollar and cents issues, but also the quality of life issues that make the money matters matter. I'm joined by Jeff Perry again, and we have Brian Regan with us still, both from Asset Management Resources. And in the last segment, we were talking a little bit about some of the perceptions that people have. And Brian, you said there was something you wanted to respond to at the break that we didn't get to complete the addressing.
Yeah, so Jeff made the comment that when we were talking about sentiment in the market, he thought people's political views were really guiding how they were feeling, and I wanted to give Jeff a chance to comment on how we think that's a really, really bad idea generally.
And it's a really bad idea, whichever party you are a member of. So this isn't Republicans might feel more nervous now because of their view of the president, the White House, but the opposite is true if a Republican was in. And, we're going to have in the next segment a very special guest, former comptroller of the United States, and he's going to share with us his thoughts on the debt and all that. But just to be clear, and I'm sure Mr. Walker will say something to this effect, but just to be clear, in modern history, recent history, the debt has grown under every president or every Congress. We're in the situation with Social Security concerns because both parties have failed. I'm a Republican. I've been a Republican for a long time. My values and my principles are more aligned with the Republican Party, but that does not mean that I believe my party, that the market's going to do better if my party is
You're absolutely
in power.
right, Jeff. It practically doubled under the Bush administration, the debts. It practically doubled again under the Obama administration, both of those 8-year terms. You don't have the same length of time for the subsequent, administrations, but the numbers
they went up.
just
They
keep
went up.
going up.
They went up. And don't, so I guess what I'm trying to answer Brian's question in a long way, which is my style, I guess, but don't make your investment decisions based upon your political views, because if you're doing that, you're probably not being objective, and you're probably not looking at the facts and the things that Brian does every day. Take the emotion and your political views out of your investment decisions.
So
I think. Oh, sorry. Go ahead.
I wrote something a while back. I don't know when it was, maybe a year and a half. And the title of the article was "Your Politics Are Very Expensive." I'm sure you could find it on our website, but towards the top of the article, there's a chart where I outline the S&P return for every single president since Richard Nixon. And you could see that every single president had positive returns with the exception of George W. Bush. So, what does that tell you? Well, if you're
This
going to be
term
out of the
ended in
market,
the midst of the Great Recession,
right. So if you're going to be out of the market just because your party's not in power, it's probably not a good idea. It would be a very expensive, very expensive proposition.
Or to be in the market because your party's in power. I mean, there's just no correlation between that, in fact.
That's true.
I go back to my quote that I love to say, and usually smile when I say it, Brian. It's time in the market, not timing the market.
Right.
I'd like to maybe transition to, we were planning this segment maybe to talk about some little lessons that we gain. We have all these interesting conversations with clients, all kinds of different opportunities to examine different scenarios. And you tend to see some lessons that are recurring, that people can benefit from if we talk about them. The specifics might be unique to each individual, but there's some recurring themes. And, one of those recurring themes tends to be around concentration, whether it's in an individual name or an industry. And sometimes it's just, incorrect allocation. People hang on to something so long it's grown, and maybe that leaves them a little overexposed to risk more than they would actually want. But, I think this is a recurring theme, Jeff, when it comes to our clients, that we see people who they've grown out of an industry, technology, telecommunications, whatever it might be, right? They tend to have an abundance of either a name of a company they've been involved with, or maybe an industry that they understand.
Right.
And they tend to gravitate toward an abundance of that in their portfolio.
Yeah. I've seen people do it with funds too. I've seen people have 4 of basically the same fund with different tickers.
Exactly right.
Like the illusion of diversification, but you're really levered to one simple factor.
It may be lots of companies, but if it's really concentrated in one industry, or it's essentially, that's not truly diversified, as an example. But great point.
Common. I've had a couple of clients recently who have been employed during their professional career for a given company for a long, long time, and part of their compensation was stock options or stock purchase programs, and it's at a discount. In many cases, an employee is able to buy their company stock at a discount. So on the surface, and it is a great deal at the time, but what happens, as you alluded to, Chris, is that over time, that position of that company stock, in this case, I had one who worked at a financial services company for a very, very long time, and we were reviewing their holdings, and I think it was over, or just about a quarter, 25% of their holdings were concentrated in this one individual stock in this individual sector. And he's their retirement age now, and that's a lot of risk in one position.
I've got the same thing with a big Staples kind of company, not the company Staples, but it's kind of company that's a lot of company stock that was acquired over the years, kept getting bigger and bigger. Part of their retirement plan, in this can create an excess concentration of wealth when it comes to sometimes, and alternatively, Jeff, I've had people who've had been stock investors just a really long time. And in the process of doing that, they've bought and held, and those stocks have just grown. And in the process, one stock can, if it does really well, can become an over-concentrated position where there's an abundance of a dominance of their portfolio's exposure in a single company. And whether it's company specific or industry specific, this is the same issue. Just the challenge is oftentimes people are reluctant to deal with capital gains. Nobody wants to pay a tax if they can afford. Fair. Oftentimes there's an emotional component of that's hey, it's been good to me, right?
That's what I see. They have an affection for the stock,
right?
Especially if it was an employer who treated them well. Right.
Yes. And that's another thing that we see often as well, is that you can find individuals who have both their wealth and their income connected to the same company, and that can add risk. If you have both these important dynamics to your financial well-being, all your eggs in this one basket, it's not something we always think about. And when we talk about, the concentration, when we think about the wealth, but the income as well can be tied to that same company. And this creates a challenge that it really creates the importance for some deliberate consideration of how much concentration are you willing to endure? How much risk are you willing to endure to have so much connected to any single company, and whether that's prudent, despite some tax consequences that may be at issue?
I had a friend in law school. He was in law school as well. We were going the same time, same class, who worked for one of the major airlines. And this is back in the period when a couple of the airlines failed. And not only did he lose his job, which is why he decided to go to law school, but he lost his pension. He lost a significant part of the pension, which was in the stock of that given airline. So it does happen. I'm sure he never thought he would lose his job as a, highly trained professional, not junior airline pilot, and, had faith in the company, and he got hit twice.
Well, Enron's the classic example, right? Where
it is.
People had both their income and a lot of their retirement savings connected to the company, and when it went under, lessons that we've learned from the past, recur, and we want to keep reminding that it's important. It's not everyone, of course, but it's one of those things that's a good lesson to take away from these kind of things. Brian, anything you want to add to that before we switch a little bit to another lesson?
Well, I mentioned the overlapping ETFs, and I see that in different ways. Some people, really concentrate on income and dividends. Jeff and I had a discussion with a client this week about that, and I was trying to, nudge him into the direction of total return. And he liked this particular stock because it paid a good dividend and it had over the past. And I said to him, quite frankly, I go, this company should not be paying a dividend. They are in financial trouble and they should be cutting their dividend. And I think that, resonated with him, that, this income stream that he really liked might go away, and the price of the stock will also not be there. So
this wasn't the stock we were talking about because it's already happened, but the reference that I always think of when you bring that up is AT&T. So many people owned that stock for
and
the
love
dividend.
that dividend. Yeah.
Yep. And many of them were employees, and then the dividend evaporated.
Let's talk about that instead for a couple of minutes. And, instead of moving on to another case, I think this issue of dividends is so understandably a recurring theme, particularly for retirees, where they think, I really want to enhance my income. And they get focused on whether it's stocks or bonds, funds or individual names, that they focus on the dividend rate. And they look at that and say, that's what I'm looking for, because that's my cash flow that I'm going to derive to spend. And so that keeps driving oftentimes investors toward a greater cash flow, a higher income level. And oftentimes that does not, it causes people to take risks that they don't recognize. They end up taking on stocks that seem like, in the case you just talked about, Jeff, with AT&T, getting at one time a 6 or 8% dividend. I forget what it was, but a very substantial dividend. And it seems like a company of great familiarity. It seems like a name that they should be confident that is going to be around. And yet there was added risk that people didn't appreciate. And ultimately the dividend gets cut. When it comes to bonds, people might be drawn to bonds that have greater credit risk or other types of risks that they may not recognize when they're drawn to these higher yielding income investments. And oftentimes that's part of the challenge with the idea of income investing, or investing with this, trying to derive solely focused on that income perspective. you may not appreciate all the risks that you're taking. And there's really other ways to deal with it. We just got about a minute left. Brian, I know you want to chime in.
So I just wanted to say a couple words about AT&T. It still pays a 6.5% dividend, but the price used to be 30. Today it's 16. So that's the lesson worth learning, right? Like it paid a 7% dividend, but it was a house of cards. You know, the stock halved and you lost half your wealth. You know, if you were only in AT&T.
Yeah, good point.
You're listening to Something More with Chris Boyd, Financial Talk Show.
Asset Management Resources, LLC, and J. Christopher Boyd, CFP, provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is in the nature of general financial comments and cannot be relied upon as pertaining to your specific situation. AMR, LLC cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.